Hi, everybody. This is Boris Schlossberg. Welcome to our lesson number 8 of our master class for technical and fundamental analysis, battle-tested day trading strategies. And today, the story is going to be all about day trading, all about the best possible, highest probability, most accurate type of day trading setups that we've been able to establish over 10 years of trading the market. Before I start, as always, trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. I ask you to read this disclaimer very carefully to understand all the risks associated with trading on margin and to seek advice from an independent financial advisor if you have any doubts. Okay, so let's start the show. Basically, technical indicators can be traced all the way back to 1900, all the way to Charles Dow, who is the father of Dow theory. And at that point, the sort of most crude, elementary way of technically trading was to see if the transports confirmed the industrials, because the idea was that if transportation index was running higher, it was confirming the strength of the economy in the industrials, and that was a great technical signal. That was pretty much the extension of the Dow theory. It's still, as a matter of fact, is in play, still in effect, and there are people who actually trade using just that particular indicator themselves. But the big problem with technical indicators is they're always backward looking. And what we like to focus on in all of our day trading strategies is actually no indicator trading at all. We never look at the past. We never look at technical indicators when we're trying to construct all of our day trading strategies, because day trading, at least from my perspective, is the ability to trade price, not the ability to trade indicators, which are lagging price, but the actual price. And in fact, I think you could reduce it to an even more precise definition, that day trading is really the ability to trade price levels. I once time tweeted out, I remember this was like everybody loved that little tweet, that investing is the art of discovering value, whereas trading, and in fact, what I meant was day trading. Day trading is the art of discovering where the sellers and the buyers are. And discovering where the sellers and the buyers are is a function of trying to understand price levels, because sellers and buyers appear at certain price levels, around the day. And if you can handicap that behavior, that is the repeatable behavior that basically is the crux and the foundation of all of our day trading strategies. So you'll notice that every chart I show you, every chart you'll ever see from me, doesn't carry a single technical indicator on it. I don't know what the moving averages are. I don't know what the Bollinger Bands are. I don't know what the MACD is. I don't know what the RSI is. I mean, I know every one of those indicators. I know exactly what they do, but I couldn't care less what they say, because the primary function of what I try to do is figure out price levels, which is where I think the true money is made in day trading. So all of these systems we're going to show you, all these strategies are actually just price driven. That's one of the things that I think may surprise you, or maybe may enlighten you, because it makes it certainly much easier and cleaner to understand the basic parameters, the basic structures of everything that we do. So a couple of basic guidelines that govern everything I'm about to tell you. This is all, it's sort of macro, it's global. These are global things that we're aware of. The first thing that we're aware of, and this is the primary reason why we couldn't care less about indicators, is because we're keenly aware that news is actually what drives the market. Technicians always say, I don't care what the news is, as long as my technical indicators line up, that's what I'm really trading. And that may work on a longer term time frame, because you can sort of, if you think about it as news as noise, right? Technicians always think about news as noise, right? Then maybe if you're in a longer term time frame, the news is never so important that it overcomes the initial signal of the technical indicator. But on a day trading basis, news is everything. The funniest thing, the most laughable thing that that I hear and that I see constantly is people who tell me, oh, there's enormous support at the 20 SMA, or there's huge play here at the 100 SMA, and out pops up some piece of news, and all of those, like 20, 50, 100, 200, 300 SMA, doesn't even freaking matter. Whatever number you throw out at it will get blown through in literally a matter of 5 seconds without any regard for the technical level, because what's really happening is supply and demand. I mean, it's sort of silly, because I think people kind of look at trading as some sort of a artificial construct, when in fact it's a very simple game of figuring out supply and demand. And news is what drives supply and demand. So if there's a massive exogenous shock to the system that's going to realign supply and demand, whatever levels you have aren't going to matter at all. So, or whatever technical indicators you have certainly aren't going to matter at all. Nobody's looking at the Fibonacci level if there is a Fed rate hike, which is why I always find it very amusing, and generally, which is why technical traders get slaughtered on a day trading basis, because they're relying on false anchors to get them in and out of trades. So what really does matter, though, is actually price levels. So, big hedge funds, large corporations, banks, nobody ever says, oh, I think I'm going to leave all my stops just above the 38.2 fib level at 1565 on dollar yen. Nobody, trust me, there isn't a single person that controls $10 billion worth of flow that thinks like that. You know what they think about? They say, you know what? I want to make sure I don't want to get stopped out. Anything above 117 yen, I want to be out of the market. Anything, below 113 yen, I want to be a buyer of the market, right? People think in round numbers, which is why it's a core foundational structure of a lot of stuff that we do. You need to be aware of key levels. So the key levels generally in the market are always current day highs, weekly highs, monthly highs, multi-monthly highs. I remember, when I first came into Forex and I stumbled into the dealing room of FXCM. It was sort of my first introduction to what professionals actually look at, and this is in the olden days. So they had these big blackboards still in the dealing room, and they had literally had the high of the day, the high of the week, the high of the month for every currency pair, and they were keenly aware of those levels, because that's where the highest probability of highs and lows, stayed. So very much you need to be aware of the news, need to be aware of key levels. And of course, and this is sort of another thing that people just completely ignore, much to their detriment, is you need to be aware of time of the day. I bet, I'm just curious, how much of the daily range of most of the major pairs, let's say, euro dollar, dollar yen, pound dollar, do you think gets done in the 4 hours of 7 o'clock in the morning New York time, which is 12 noon GMT, to 11 o'clock in the morning, New York time, which is 4 p.m. So between 12 noon, between London lunch and London close, how much of the percent of the range, let's say the range is 100 points that day, how much of that gets done during those 4 hours? Feel free to type it in. I'm just curious to see what you guys think. Anybody have any guesses? Chen says 80%. It's a good guess. It's pretty close. It really is sort of the 80-20 rule. This is what I think people don't understand. That for the most part, now it's all contingent on, of course, news. If you have the Bank of Japan in Asia, that's certainly going to be responsible for a huge big movement in Asia. But how often does that happen? Once every 3 months, 1 out of 60 days. When you have some news, maybe 1 out of 20 days. 15 out of 20 days, probably like 80% of the days, 80% of the price action is going to happen during New York hours, because that's when the New York morning and the London afternoon is when you have the biggest concentration of players all vying for advantage, and that's where all of the price action happens. So a lot of, your ideas will either work really well or get smashed to smithereens during that particular time frame, depending on whether you're trading volatility or non-volatile type of ideas. If you're trading breakouts, it's generally a pretty good time to trade breakouts. If you're trading breakouts, very dangerous to do that at that time. So it's very important to really, if nothing else, to have a foundational respect for these three things: news, key levels, and times of day, as before you even begin to consider doing a day trade. Is that clear? I'm just going to pause for a second, make sure everybody is really clear on all those points. Let me know. Just type in yes into the box if you guys are good with these points. Okay, excellent. All right. So now I have a slew of strategies that I'm going to share with you today. First, we're going to talk a little bit about some London strategies, and then I'm going to talk to you about some of the core strategies that we trade in our day trading room and sort of the evolution of how a lot of those strategies came. Now, I'm going to give you lots and lots of different trade setups. I'll show you what I trade. What I trade does not necessarily mean it should be something that you should trade. The reason I'm going to give you lots and lots of trade setups is because I want you to find the setup that you like the most. One of the most important things, one of the key ingredients to success in trading is not to find one setup. The key ingredient to success in trading is to find the one setup that works for you psychologically, right? And that's very, very important. You need to be able to be confident and, most importantly, comfortable in doing the setup. So it's not that I'm going to prefer one or the other of these setups. I actually want you to consider all of them, and then through experimentation and decision, decide which one you like, and most importantly, which one you're most comfortable to do. Because the key to success of a setup is not the setup itself, but whether you're actually going to execute it to its specifications. And a lot of that has to do with your own psychology, which is very different for everybody. So a couple of things on a London break. London break is a kind of a very cool, interesting, intelligent or counterintuitive type of strategy. It happens quite frequently. And it really happens sort of in the early morning hours, when Asia is kind of in the afternoon and London just comes on board. And so what happens during this particular time is you have some end of session Asia orders that come onto the London desks that they get passed over. And most importantly, you have a lot of overnight business that London picks up. Remember, London is the core. It's the heart of the FX world. There are 200 banks in London that make markets in FX. So they have a tremendous amount of orders on the books from all across the world. And they love to run those orders. That's why you'll find some very interesting and unnerving moves in this early morning time before news, before anything really hits the market. And a lot of it is just price driven. So let's consider this London break idea. First and foremost, we identify the range, which is between 6 and 8 GMT, obviously before all the news hits in Europe, right? We are looking now for the currency pair to make a new range low or range high by 5 pips. In other words, we're looking for that range to get broken to the upside or to the downside, but at least by 5 pips before we commit any capital to the idea. But if it does break by about 5 pips, we're looking for a momentum move. We're looking for it to continue in the direction it wants to go with a stop of 20 and a target of 20. And that's because what happens very frequently during this particular time is you get these sudden runs, right? Runs in one direction, runs in the other direction. And they're basically a function of somebody putting in a big order and the dealers just running stops. They're saying, I got $1 billion of cable to sell. I'm going to hit 70s, 80s, 60s until the whole order is done and the market has absorbed the order. And you can come along for the ride once you can identify that particular structure. Let me just see. It looks like there's some questions here, so I just want to make sure. Okay, no, everybody's good in the questions. Okay, so let me show you how this looks in real life. So here you are, and this is obviously we're using New York time. So translate this. Trust me, this is GMT. It's basically 1 o'clock in the morning, 3 o'clock in the morning for us, which is going to be 6 to 8 GMT time. And see, here we have range 110 to 110.40 is actually quite big range, right? And then it pops up above that range, right around that time. So 5 points above, we're coming in at 10.45, 110.45. Stop would be 110.25, right? 20 points below, and target is 65. And you can see this is a 5-minute chart. This thing just flies. Generally these things resolve themselves. The other thing that's very interesting for everybody to note is, and this is a general rule of thumb. It's not always going to be the case, but this is a really good general rule of thumb. Almost every single idea I'm going to give you should, doesn't always, but should resolve itself, meaning it's either going to hit the target or it's going to get stopped out in no more than half an hour. 30 minutes to probably maximum of about an hour. Very, very rarely you'll just get stuff that just doesn't move at all because slow day, low volatility day, whatever. But almost every single setup, it's one of those. It's actually a very, very good idea to keep a time stamp on your setups as much as a price stamp, because if you haven't hit the target within 30 to 40 minutes of the trade, and the trade's kind of just floating around, and if maybe you're marginally positive, it's almost always a good idea to just get out. Just get out. Because if it hasn't resolved by then, the chances are it's actually going to go against you. So I used to use a time stop as much as a price stop. And within 35 to 40 minutes, if I'm not done on the trade, I want to be out of it. Because the whole idea here is to do multiple ideas of trades and really resolve them very quickly. I mean, most of these trades resolve within 5 to 15 minutes of structure. And you can see this one going by very fast, right? So here's another one to the downside where, start with the range basically, see it pops up, pops back down, and then it finds kind of true direction, or at least true enough direction for our purpose, drops through the 109.60s. We sell 109.55s and TP at 109.35s right over here, right? Again, 10, 15 minutes, and then it finally exhausts itself, and then it could completely turn itself around. Here's a big, big breakout above the 109.45s. Boom. Again, done in 10 minutes, right? Big runs, right? We just want to catch that big run off the range because that's very important. Here's one that this is the reason why we use the sort of 5 pip range here is because sometimes they'll poke their head, right? The key to momentum is it's got to be moving, right? And therefore, the price has to prove to you that it's actually moving in the direction you want it to. When you're buying breakouts, breakdowns, you actually want, ironically enough, to pay the worst price. Because the worse the price you pay, the more likely it means that it's a runner. I want to just make sure that everybody understands that. When you're buying or selling breakouts, breakdowns, you actually want to chase price because that means there's a chase going on. Is that clear to everybody? That's why we had that 5 pip grace or sort of a grace period because we want to make sure that it's a genuine break, not a fake break. Fake breaks just peep in and peep out, right? This is a true break, and then it goes straight to target very, very quickly. I'm just want to make sure I'm caught up on all my comments here. Okay. So that's a very clean, clear London break trade. It's 1 trade per day, right? And generally, this is the example of when we're using it on the euro dollar. Euro dollar is probably the best currency pair to trade this on. The secondary pair that I would trade on would be the pound dollar. It's really the 2 European currencies where you have the greatest probability of this going on because that's really where all the orders are going to be. Remember, it makes sense that it's going to be the Europeans are going to be focused on European currencies. I never trade the Swiss franc since the SNB decision, so don't even ask me about it. I'm sure there's possibilities in it, but I literally never look at the Swiss franc. It's just too dangerous a currency, I think, to get involved in with very high margins to boot. So we just stay away from the Swiss franc. There's also a lot of like intraday intervention in the Swiss franc because SMB really hates having it so strong. So really, I focus on as far as the European side goes, I only focus on the euro and the pound, and those are the two best currencies for which you want to trade this with. Okay. So setup number 2 is a trade we call Yankee reversal trade. And this is sort of a very interesting, flip on the variation of this idea. So after we have the original, early morning move in the pound of the dollar, right? We're actually looking for the market to get caught off guard, to go completely the other way. So the long rules in this is that we're actually looking for a pre-New York range, right? Like we want to identify between 05 o'clock and 06:30 New York time, which is 10 to 11:30 GMT. What's the range, right? What is the highs and lows of that range, right? So here's the range, right? Between 5 and 6:30 GMT, right? Blah, 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 right? Then we're looking for that range to be either broken to the upside or, broken to the downside. So in this case, we're going to look for a long ride. So look for the pound dollar to break the range high by 10 pips, but before the New York Open, because then all the New York news comes in and it completely invalidates the trade. So in this case, what we're looking for is, here's the range, right? And we're looking for the pound to stage a rally to the upside or a rally to the downside during the London morning, before the New York people come in. Because this is one of the interesting things that happens quite a lot. You'll notice this. Is London, may take something up, and then New York will completely reverse it. Or conversely, London will take something down, and New York will buy it all up and bring it the other way around. That's very, very common. That's why you need to understand the time of day and the forces that are in play at that time of day, because they have very, very different dynamics on how the price trades. But in this particular case, we're going to buy the 43.30, and it makes target again in less than about 30 minutes at 43.50. Boom, big breakout, right? So this is the Yankee reversal done a little bit right over here. Boom, boom, boom. So this is the range is 18. We buy at 28, and it makes target at 58 over here, right? Same kind of a thing. We like to use 1-to-1 target because really, honestly, all we need is a 60% accuracy for this thing to work, and it does work pretty close to a 60% accuracy rate, meaning that 6 out of 10 times the break is going to be legitimate, right? Now you could really refine a lot of this stuff. It's up to you. This is a sort of a pure raw strategy. You could do a whole bunch of stuff to make your life better or worse depending on how you want to look at it. But you could say, I'm going to sell half at 10, move to stop to break even, right? That's going to clearly increase your hit ratio, your win ratio, maybe as high as to 80%, but it also is going to give up your upside as well. So it depends on how, you can play around with this. There's 100 different ways to play around with this variant, but just simply a straight up variant 2020 is usually good for at least 55 to 60% edge, which is good enough for a long-term edge to the positive side, right? And here, here's the target here, and here's the stop. The short rules is the exact opposite. We're looking for the range, and we're simply looking for it to break that range, right? By 10 pips before, right over here. Here it breaks the range, right? And then we're gonna go and get short this thing, right? Again, we're short over here with a target of 41.01, right? And the stop is right over here. And again, it doesn't. The reason why 20 is a good range, especially on the pound, because the pound tends to be, first of all, pound has wider spreads, tends to have a lot more volatility, and anything less than a 20-point stop on a pound almost assures you that you're going to get stopped out. So you almost need to have 20-point stops just to stay in any kind of a pound trade on a short-term basis. And so therefore, you really want to look for a 20-point target to make sure that you can stay alive, in the pound trade, right? So you're looking to offset that risk with the same kind of reward, so you could have at least a better than one-to-one edge in the full trade, right? And so, as I said, the reason why the technique works is because it's sort of a continuation of the early morning London sentiment, right? The market decides, oh, we like dollars, we like pounds, we want to sell pounds, we want to do this, and you get this early momentum burst, and generally that's what that's where the market tries to push the pairs. So once the range is broken, that's where that's where the market tries to figure it out. And then as you can see, we'll have sometimes New York consolidation, because of course New York's going to come in and say, we think this is way too cheap. We're going to buy it. And then maybe New York news comes in is completely different than what the London news was, and everybody decides, we want to sell dollars and we're going to buy pounds, and they do the exact opposite and they reverse the whole thing. One of the interesting things, and it's for somebody who's new, it could be extremely frustrating, but for somebody who's been around, it's actually quite amusing, and it's actually quite interesting. The fallacy that everybody tells you is that Forex is a continuous 24-hour-a-day market. Now, in principle, it is, but in practice, it's actually a very, very distinct market at very distinct times of the day, and it's extremely important to understand that. I'm going to show you actually how we have a very, very specific strategy for time of the day that completely and totally tries to take advantage, basically capitalizes on the notion that there's a very distinct behavior pattern depending on the time of the day. That's really a very key thing that you need to appreciate when you're looking at a lot of these strategies. So this is the Yankee reversal. Let me see if we have any more slides on the Yankee reversal. No, I think that's it. Okay. Let me just sort of stop here for a second. Make sure everybody's clear on the early London morning break and in the Yankee reversal as strategies. If you guys have any questions, feel free to ask me right now. I'll give you a second here to ask me any questions that you have. But these are single entry, single exit strategies, very, very simple to execute. And actually, these require very, very little. These things can actually be done manually, right? Including this one. As a matter of fact, I think sort of the first three, you really don't need MT4 to execute, because you could execute these manually, and they're pretty simple to understand. So any questions? I don't see any questions. Sounds like everybody's pretty clear on the two London ones. So now comes one of my sort of old time favorites. This is a strategy that I've been trading, I know, like for 7 or 8 years actually, and it can be an incredibly lucrative strategy, especially in strong trending markets. Like over the last month and a half, this has been a great strategy to employ. And it's also extraordinarily sort of simple to understand. Now, I'm going to show you the rules, but then I'm going to take you to the charts, because I think it's much better if you look at the charts as well to fully comprehend what I do with the running for the OOs. I told you earlier that the OO levels, the 1,500 in the yen, the 105 in the euro, 104 in the euro, the penny level. Basically, remember, we trade FX in pennies, right? We trade in 1/100th of a penny. Every single pip is 1/100th of a penny, effectively, right? So every penny is a big level. Every penny tells the market, hey, currencies moved up by a penny. That's an important piece of information. And more importantly, human beings tend to be very, very predictable. I'll never forget this one lesson that I learned from, actually, of all people, an acting professor in high school. There was a theater professor in high school, and I took this this is senior year, so of course I was taking all these bogus classes. So I was taking this art class, this theater class, and every day, the interesting thing was that this was 1980s, when there was still some rules, I guess, in American high school. Every other teacher had a seating chart, right? They would tell you sitting in this seat, you're sitting in this seat, you're sitting in this seat, right? And so what was really bizarre about this class was that everybody would walk into this class, and this professor, who was our theater professor, didn't have a seating chart, right? So everybody at first, the first day, everybody was very uncomfortable, and they took the seat, whatever seat they were sitting in, right? Then after that, they, he never ever mentioned a word about it, right? Like a week goes by and everybody was still not given a seating assignment, right? So in the week after that, he says, all of a sudden he says, what is the seat you're sitting in? Was this the seat you were sitting in the first day that you came in? And lo and behold, that naturally, absolutely without any direction, without any prompt, everybody wound up sitting by habit in the exact same seat they chose on the first day of class. And that was his point, that human mind seeks order habitually, that we don't even know it, but subconsciously we seek order. So the reason why this is important is because it brings me to the idea of why the 0-0 level is so important. Because even though everybody knows it, and even though everybody understands that, it's silly and it's kind of stupid, people still leave their stop losses around the 0-0 level. They say, if it goes to 117, stop me out, right? And of course, who knows this better than the dealers in trying to exploit this particular behavior? So the run for the 0-0s is basically the idea of exploiting this very, very common human habit of running for the 0-0s, the ability, to go for the same level over and over again. So what we're basically looking for, right, is for the long trade, right, is for the currency pair to go underneath from below 50 to above the 50 level, right? In other words, from below the 50 sub penny mark to above the 50 sub penny mark. If we move through the 50 level, right, above the 50 level, and you think about this, if you're an American, you think about this as your half field line, and if you're European or an Asian, you think about it as the half mark line in the soccer field, right, in the football field, right? If we go into the enemy territory, right, into the attack, into the other team's territory, and I think the sports metaphor is very, very easy to understand here, because in America, the territory between 80 and 0, or between 20 and 0, is what's called the red zone. And in football, in soccer, it's what's called the penalty area. That's where do we score the goals? We score the goals primarily in that 20 to 0 zone or the 80 to 0 zone, right? So what we do is, if we get a run in a currency pair and it goes to the 80, then we make the assumption that it has enough momentum to go run to the 0-0s, right? But here's where the trade gets kind of interesting. So we place the order to go long at 80, right? We put a stop at 20 points behind, right? And this is where we have the potential here to make a lot of money. Because what we do is we only take half our profit at the 0-0 level, right? And then we move the stop to break even. So in other words, we come in at 80, we buy 80, it goes to 0-0, we take half the position off. Let's say we trade 2 units, right? The second unit, we move to break even, right? Then it moves to 20. Then we move the second unit to 0-0. Then it moves to 40, and we move the second unit to 20. Now, that doesn't happen a lot, but maybe, 1 out of 7 times, 1 out of 8 times, you get this incredibly strong run, right? And the second unit, this is the key thing, the second unit could potentially, by itself, by trailing 20 points, could lock in 60, maybe even as much as 80 points of profit, right, on the second unit. Remember, we already have 20 points of profit, right? So when you get those big runners, right, let's say you can lock in 60 points of profit on the second unit, right, and you've locked in 20 points of profit on the first unit. Now you've gotten yourself 80 points of profit on the trade, and you've only risked 40 points because you risked 20 twice, right? And remember, because you are taking half off at the 20, right? You're actually much more than just 50% likely to have that trade happen, right? You're looking for the momentum trade. Let's say even 55% of the time it's gonna hit the 0-0 level, right? So that means you're only going to lose 45% of the time. The other, you're already naturally going to win more of the time. And the beautiful thing is that half the time that you're going to win twice as much as what you lose. And that is what gives you the very interesting edge in this particular strategy, right? It's sort of a classic. There are very few positive risk reward strategies that I trade, but this is one of them. And this is what makes it so interesting, you know. Oops. So here it is, 57.80, right? It gets triggered, and boom, usually, it sort of resolves itself incredibly quickly in the trade, right? Here's one. This is the kind of stuff that I'm talking about. You go long 92.80. The first target is hit 9,300, right? We move the stop to 92.80, and then we can just trail it up. And actually, I think it doesn't stop us out until we would go 90. First we would go 92.80, then we go 93, then we go 92, 93.20, right? It's at 40, right? And then it goes to 60, and I think it only stops out at 40, right? So right over here. So this particular structure, we make money 60 points on the second position, 20 points on the first. That's 80 points on the whole thing, which is great, right? Here's one at sometimes it's simply just going to run the 00 and then come right back down, come right back out, right? And occasionally, of course, we get stopped out. That's it's par for the course. By the way, notice one of the interesting things. Notice when this happens. This is 1 o'clock to 3 o'clock New York time. Very, very quiet dead zone. In the dead zone, it doesn't happen. When does this best happen? It happens in the New York zone. The New York zone. Remember I told you that 8 o'clock New York to 12 noon New York. That's when the gravy happens. That's when you really get a chance to make these strategies, sing. So the short trade is the exact same thing, except now it's got to drop from the 50 level all the way down to below, and we're looking to sell the 20s for a run towards the 5,700, right? We sell the 20s for a run to 5,700, and here's a trade that does that very well, right? And doesn't actually even wash out, right? We sell the 50, we hit the 5,700, move the stop to 5,720, and then eventually trailing this down, I think we can get it back to 56.50, which is another 60-point target on the shorts. And, here's a couple of more examples on the shorts. I just want to make sure that I'm okay on time, so I don't want to. I'm actually going to speed up a little bit because I want to make sure that everybody understands. So is that clear? And believe me, guys, I think what I'm going to do in order to make sure that everybody is fully comfortable with this stuff is we'll save all the charting examples, all the live chart examples, and everything else for the Wednesday session, so that everybody can absorb that properly. And then we'll talk about how to set up the MT4 at that point. Right now, I'm just gonna go through all the rules because the boomer setup, which is the core of what we do in our day trading room all day long, has so many different variations that I really want to just take the time to go through all of them right now. And then I'll go through all the chart examples later. If you have any questions, feel free to type them out, right? So, the first thing you need to understand is the philosophical underpinning for this particular setup, which may seem insane to you, is the insurance business. I'll just sort of very quickly summarize to you why this works. If you've ever bought term life insurance, you know what term life insurance is? Term life insurance is where you pay $1,000 and they tell you, we'll give you $1 million if you die, right? And you think, wow, what a crazy, incredibly positive risk-reward ratio to me. They're willing to risk $1 million just to collect $1,000 from me. And what a crazy idea. I'm certainly going to buy that product. And you buy that product, right? And of course, the loser is you. Because the idea behind term life insurance is that, of course, they're going to pay you $1 million, but only if you die within that 1 year that you've bought the insurance policy. And, they're not going to sell it to you if you're like older than 55. If you're 55, it's already going to cost you $4,000. If you're 60, it's going to cost you $20,000 to get $1 million. If you're 70, it's going to cost you $100,000 to get $1 million. The point is, the closer you get to actual death, the less they're going to make those same odds to you. They're more than happy to price you at $1,000 because they know that at the age of 35, your chance of dying, except from some freak car accident, which is a 1 in a million chance. Just think about this. If I sell 1 million people $1,000 worth of insurance, right? And one of those people dies because of a car accident, right? I've collected $100 million and I got to pay out $1 million. Big deal. I'm still way ahead. By the way, the actual numbers, just so you guys should know, I spoke to an insurance guy. I found out the real reason. For every 60,000 insurance policies that they write, basically they only have to cash in one. Only one policy goes against them. So it's obviously like a 99% accuracy kind of a thing, right? So this is sort of a similar idea. The Boomer Classic strategy is a strategy that some people in my room have literally traded with one loss out of 100, like a 99% accuracy. So when you have that kind of a structure, obviously, risking 110 to make 10 is very lucrative, although it seems utterly insane. But the reason why this works is, again, because the people who do this very well in my room never trade in front of news, never traded, in New York session, always trade in basically they're always looking for that 35-year-old healthy guy. They're looking for the least amount of risk possible when they want to put on this trade. It's a selectivity trade. But the trade is very simple. Basically, what we do in this particular trade is when the price drops below the 00, we're looking for the price to snap back. We're thinking, okay, they're going to sell the 00s. They're going to trip the stops, right? So we buy at 85 with a stop at the 50 level, at the next 50 level. And our target is only 10. And then if it keeps coming down, we buy at 75, and now our take profit is 85. And then if it comes back to 65, we increase our size to 2 times this. And again, we just target 10 points. The reason why this is such a high probability trade is because we're very, very disciplined on the target, right? Remember that this trade has to literally fall in a continuous line from 0 to 50 in order for it to get completely blown out. And that only happens under news situations. And we, of course, never trade during news time. So post-news, after all the news has happened, generally this kind of a straight line move is very rare. It's always going to come back a little bit. And that's what gives us that high confidence that we're going to be able to make that 10 points. And we're basically going to be at around 95% accuracy on the trade, right? The short version of the Boomer Classic, exact same thing, except now if the price is rising above the 00 level, we sell the 15, we sell the 25, we sell the 35 until we can get that 10 points and just resolve the trade, in our favor. So just want to make sure that everybody is clear on how the Boomer Classic basically works. And Charlie's asking, what is a bad time for FX trading? Well, I'll give you an example. A bad time to trade this particular strategy. This strategy is based upon the idea that prices are going to basically come back to their original level. Between 8 o'clock New York and 12 noon New York, this is generally not a good time to do this because that's when prices are going to run. There's going to be news. There's going to be a lot of stuff, right? A good time to trade this would be between noon New York and, 4 o'clock New York, Another good time to trade this probably would be around like midnight New York to about 4 o'clock in the morning New York during the Asia close, during the Asia afternoon and early London before the news heats up. So you got to know your pockets of when you want to trade this stuff. Those are the best times to trade this, right? So the other thing is this is really, really important. Not only do you need to know when not to trade in front of news, but you need to understand this is something that almost every rookie trader falls for. They get greedy because they see, I'm making so much money. If I'm making so much money with all these currency pairs, I can just increase my currency pairs and make more money. No. Remember, the 00 levels are a function of the major market players, right? People only focus on the yen, the euro, the pound, the Aussie, the Kiwi, the Canadian dollar. They're not focused on CAD yen. they're not focused on Aussie Kiwi. They're not focused on Euro Aussie. I mean, they may be focused on that, but uh, the percentage of people, let's say if Euro dollar is 100% of the market that everybody's focusing on, Euro Aussie would be maybe 10% of the market, and pound Aussie would be 1% of the market, right? So just the fact that the pound Aussie goes through the 155 level is not by any means a reason for why you think it should be a good candidate, not a good candidate, but let's say a 95% candidate for accuracy of your trade. It may work more than 50%. It may even work 70% of the time, but that's not good enough for this particular strategy. So we only traded on the majors, on the euro, on the pound, on the yen. Those are the key majors in which you want to trade. And by the way, we never trade this these days on the dollar CAD, because the Canadian dollar is basically like trading oil. At this point, the Canadian dollar is just literally an oil trade. And because it's an oil trade, because it's impossible to handicap oil, it breaks every rule of all of this stuff. It's a loser trade. We literally don't trade the Canadian dollar in any of these setups because of the fact that it's a loser trade, right? Now, there are a lot of people that like to say, well, you know what? What if it goes through the OO level more than once? Maybe I want to recycle this trade. So a couple of people in my room have come up with what we call the recycle version that makes the risk reward much more palatable. In this case, we don't take the full 110 point of risk, right? We take just essentially a 30-point stop. And in my original structure, the stop was all the way out to the 50 level. In this particular structure, the stop is only out to the 40 level, right? And so we buy at 10 with a terminal stop at the 40, or a terminal stop in this case at 90 would be at 60, right? Going to the downside. We buy it at 80. There's only two averages in. Same kind of idea. And in this case, the risk reward is much more palatable. So we can afford to be, we don't have to be 95% accurate. If we can be like 6 out of 7, this becomes a very valuable thing. This works very, very well in Asia. A lot of people love to trade this in Asia because in Asia, you'll get these big runs up and down across the OO level all the time. And you can sometimes make 10, 20, 30, 40 points against the same currency pair in just the Asia session alone. And, the short version is just simply the reverse, right? So in this particular case, people also like to you can also trade this with crosses, because remember, the risk here is much smaller, so you can afford to have a less accurate structure, right? And you can look for low volatility sessions, and that's a recycle. That's a recycle rule. Another variant, and this is the reason why I bring this up, is because this is sort of a core of what I do now. This is not what I do now, but it's sort of like it's the beginning foundational stuff of what I do now. Is what we call the boomer basic, and this whole idea is that once price goes through the OO level, right, there is a very high probability factor that it will get chunky. It will get stalled at around the 35 pip level, in front of the 50 level. It sort of, if you think about it, it's 2/3 of the move towards the 50. There's going to be a lot of pressure to defend against that 50 getting hit, right? There's always the OO level, and the 50 level is sort of the sub level. And so the probability that if you ran from 0 to 35, that it's going to come back. It's going to come back just by 5 points. This should be by I guess it's point. I'm using 0.5 because I just want to make sure I get into the trade. The point is going to come back and just make 5 points. That's all I'm looking for, is to make 5 points with the 15-point stop, very high. And here, it's a 3-to-1 risk reward ratio. So again, if you're 4 out of 5 accurate, you're making money on this trade. And that's a very, very interesting trade that works quite well, right? Now, the last of the boomer trades that we do, and this is actually a very good structure setup. I absolutely love this setup. It works so well. Is what we call the boomer news setup, and this we love to use right after the news happens, right? So we basically have the news occur, right? The news occur, and we give it about 10 minutes. This especially works super well in Australia and New Zealand against news. If you remember in some of the earlier sessions when I told you about, when we talked about the idea of fading the Australian news or fading the New Zealand news, meaning, here's news, there's a huge reaction, we're going to give it 10 minutes, and then we're going to do the exact opposite. So if it's a huge up move, we're going to sell the up move. If it's a huge down move, we're going to buy the down move, right? Well, the actual physical structure, the actual trade structure that we use to enable the fate of the Aussie move or the fate of the Kiwi move post news is this, what we call the boomer news structure, which is what we're going to buy at market 10 minutes after the event, right? The stop is 20, our target is 10. And if the price moves against us by 10 points, we buy again with a target of 10. Here, risk reward is minus 30 against 10, but this is such a highly accurate, this is basically 4 to 5, 5 out of 6 type of a trade, right? Generally, especially against Australia and New Zealand, the initial news reaction is almost always favorable. Almost always favorable. It doesn't mean it's always favorable. Almost always favorable. And that gives you a very high probability, especially with this 1-2 structure on the boomer news way. Let me see if there's any questions here, because there's so much. There's just so much deep information here that I've given you. And I promise you, trust me, on Wednesday, I will go through this on charts with you, so you can see visually on charts. I'll show you some live trades that we did on all of this stuff, so you get a full feeling of all of this. One last idea, and all of this is possible with the EA that's going to be included in this course, is that you can also do, not my favorite, by the way. I don't love this. I don't love this this trade, but a lot of people like it because it just simply increases their chances of success. We call it dynamic news stop. And it's basically the same idea, but what we try and do is the following. We try to target a big pop back, right? So the stop is 20. The target now is plus 15 instead of plus 10. And now if the price goes to plus 5, we move the stop to plus 4, right? What happens, unfortunately, literally like 8 out of 10 times, is that you're going to get stopped out at plus 4. You're going to make a small amount of money plus 4 almost all the time. Occasionally, you get such a huge run the other way that it goes all the way up to plus 15. And the whole idea here is that as long as it moves in your direction, just even by a little bit, you lock in that, and you hope to go for a larger target. But it doesn't it doesn't work that well. Now, here comes the strategy that I trade almost all the time. And you guys will forgive me if we go just another 5-10 minutes overtime. I always seem to always go overtime with you guys, but there's a couple more strategies that I just want to share with you. So here comes the core strategy that we love to trade. Now, this is primarily what everybody else in the room trades, and I'll show you my own variation of the strategy. So remember I told you that we like that 35 to 40 level, that if it goes from 0-0 to 35 to 40, we think it's going to stall. So the original boomer stall that a lot of people in my room trade is the following. You buy, let's say the price is dropping through the 00 level, right? We buy the 60 with a 20 stop, which means the stop is at 40, right? We'll buy the 55, again, with a 40 stop. And the whole idea here is to make plus 9. So on the first target, you make plus 9. So you buy 60, your target is 69. If you buy 55, all you need is plus 7, because you're going to make 2 points on the 60 and you make 7 points on the 55. So overall, your target is going to be 9. And again, this is obviously a big negative risk reward ratio, but it's a very high accuracy trade, and we like to trade this quite a lot. So for those people who like to trade sort of like a plus, it's basically plus 10, but we made it plus 9. The maximum risk here is very, very modest. It's only 35 pips. And you try to make 3 or 4 of these a day, to bank up, 30, 40 pips a day. And you hope, your target here is to be sort of 1 out of 7. You want to have one loser per 7 trades, 1 loser per 8 trades. If you can get to that level, you're really doing very, very well. On the short side, you start selling at 40. Then you have a second sell at 45. Again, you're stopped out at 60 if it goes all the way up to 60, and the same structure, plus 9, plus 7, right? Now, what I personally do, and again, as I said, this is a question of comfort level, right? I'm a person who really has zero zero patience. And even 10 pips for me is sometimes psychological torture to hold on to, right? I like to resolve my trades really, really quickly. And I also don't like 30. Believe it or not, 35 pips is a big risk for me. I don't like losing 35 pips. You know, it's a big hit for me, right? So what I've done in terms of all my trading in our chat room is what I created what's called the Boris variation of the boomer stall, and it has a couple of interesting facets to it that I think you'll find fascinating. So first and foremost, yeah, okay. So let me do the long version. First and foremost, one of the things that I sort of realized is that because of spread, and sometimes because of everybody's aware of these 60-40 levels, the price will just go right in front of the 60 level, but never quite come down to 60. Like, you can't get executed at 60. My whole idea is, if you didn't get executed at your level, that means you were right, but you just couldn't get your level. That means the market was a little smarter. So what I try and do is I front run the market. So the first thing I did was I actually put my buy orders now at 62, 2 points above the 60 level, so that I have a higher chance of getting into a trade, because the whole point is boom, boom. My ideal trade is it hits my target and it pounces back up. That's what the perfect stall trade is. Boom, boom. I literally have no slippage, right? I hit the bottom. I top tick. I bottom tick. That's what I try and do. So, we bought at 62, and but I've also truncated my risk, right? Now I put my risk at 17. So my stop is at 45, and my target is only 5 pips, just 5 pips. That's all I want to make on every single trade, right? The second thing I did that's kind of interesting is I actually elongated my second entry. Instead of making my second entry such a short distance, the whole idea here is, if it's going to go deep against you, right, you want a good toe hold on the second position. You don't want to be risking too much in the second position. And the whole idea is, if it's going to blow through your stops, then you just want to lose as little as possible in the second position. But if it comes in sort of just before your stop, then you have a really quick and good opportunity to resolve the whole trade positively, because you will have averaged in at a very decent price. So I come in 62, I come in 53 now, and on the second, I have a much shorter target on the second stop, and my target here is only +7, which makes the whole trade +5. I resolve the whole trade at 60. In other words, my original trade was 62, and here, all it has to do is go back to 60, not my original entry, and I've still made my home trade. And here, the risk-reward ratio is really compressed. It's 25 to 5. Now I'm only risking is 25 points. And excuse me, if I'm doing my job right, I should be running 8 out of 9 trades. If I'm doing a really good job, I should be running 9 out of 10 trades positively. That's the target of the boomer stall. The short version works the other way, but I'm simply selling at the 33 level here. Again, I'm fronting the 35. I'm hoping the 33 triggers, and and then the stops come in. I actually, I have, if you just indulge me for 1 second, let me see if I can. Let me see if I can pull from my blah 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 blah. Yeah. So let me just escape here. And I'll show this more to you guys when I talk to you guys on Wednesday. But here's a classic. This was dollar yen, 115.33 on Friday, right? That 33 level, right? I sell it. This is a 1 minute chart. You can see it's a 1 minute chart. So you can see I have zero patience. The whole trade starts at around 12:19, and I'm done by 12:30, 38, right? And this is actually a very long duration trade for me. So we sold at 33s, and you notice, by the way, look, I'm rarely in a situation where I'm more than 2 or 3 pips out of the money. I pretty much, hit the top, and then it, comes in, and I made my target. It's just one example. I'll show you plenty on Wednesday of these trades that we do. The whole idea is to do, 6-7 trades of these every single day. So I'm over time, and I think I'm going to stop over here. I've given you a ton of various setups. It's a lot to chew on. Of course, the PDF is going to be there. Of course, I'm going to put the video up in about an hour, and I'll email everything. But then uh, on Wednesday, we'll go through this piece by piece on the charts, so it's really visually viable to you, and then I'll show you simultaneously on how to set up each one of these structures on the EA to make sure that the EA executes your strategy exactly as the recipe is written over here. So, any final questions before we kind of wrap it up? Let me see if you guys have any questions here. And if not, then we're over time. I will, as I promised you, I will. I know this is a very, very dense part of it, but this is in many ways the core of the course. So I really wanted you guys to have as many ideas as possible so that you could find the one idea that makes the most sense for you on a day trading basis. Every single broker uses MT4. So the favorite boomer is the Boris variation. That's what I trade. This is what I trade. I trade the 5 point trade. I did this all day long. So this was, I think. Let me show this to you. So this was just Friday, just me banging away, and I had a couple of bogus euro pound trades, but this was just me banging away. This is what I try and do. I try and just collect 5 points, 6, 7, 10 times a day, right? So this was all the trades that we did on Friday. Okay. Okay, great. Thank you so much, guys. My apologies for keeping you a little bit over time, but I hope you found it very interesting. And as I said, on Wednesday, please come join me in the class because we're going to really deconstruct this on a chart basis and on the MT4 basis and get this really hopefully under your belt. Thank you again. I will see you guys on Wednesday. Everybody have a wonderful night and wonderful morning for those of you in Asia.